Well, guys, I hope you got some great Black Friday deals during this Thanksgiving season, though I hope you didn't spend all of your money on cheap televisions and new gym memberships, because right now we're also starting the Black Friday of the annual housing cycle. And this Black Friday period, which I'll define in a moment, is going to be especially good for California home shoppers. Now, we're going to look at the latest Redfin data and California Association of Realtors data to show you exactly why from now until the Super Bowl, or if you want to be political about it, until the inauguration, from now until late January, early February is the best time to buy a home, not just in America, but especially in California. Welcome to the California Real Estate Roundup for December 2024. Let's get right into it. All right, we're starting with the latest Redfin monthly data for the state of California, and I'm using this just to show you the annual housing cycle. Now, prices generally go up, but as you can see, they don't go straight up like the arrow I just drew. Rather, home prices go up and come down, go up and come down, go up and come down, go up and come down. And this is a very reliable annual cycle until we get to the pandemic, when things kind of got really screwy over the past couple of years. And what you'll notice is that these price gains all start at the beginning of the year, and it's the second half of the year where prices fall. Why is this? Well, most home buyers and home sellers are families, and most families try to move between school years. So the high time for buying or selling a home is the spring and summer. The low season for buying or selling a home is in the winter, specifically from Thanksgiving to the Super Bowl. Why? Well, a couple of reasons. One, most home buyers and home sellers, they've found where they want to live, and they're going to stay put for the school year. But also just in the life, there's so much going on in December. I mean, you have the holidays, you have winter travel, you have the new year. Most home buyers just take their eye off the ball during this window from Thanksgiving to the Super Bowl. So even though there are fewer home sellers on the market at this time, there's even fewer home buyers on the market at this time, and that's why prices fall. So independent of the California data that we're about to research, now is a great time to go shopping for a home. The inventory won't be as plentiful as you get in the summertime, just fewer people are listing their homes, but the way life works, some people have to sell their homes in December. And trust me, if someone is selling a home in December, it's only because they have to sell it. Combine that with the fact that there are fewer buyers and you get falling prices. Now let's take a look at the most recent data from the California Association of Realtors to see why this is such a good period, especially in the state of California. So we're looking at the most recent monthly print from the California Association of Realtors, and what we're seeing is a market that is coming back into good health. You can see that sales are up 9.5% over last year to an annualized rate of 264,870 sales. But what's also great is that inventory is up to 3.1 months of unsold inventory on the market. That's up almost 15% from last year. And what's also great is that median days on market is up to 25 days. That's 25% more days on market than this time last year. More sales, more inventory, and a slightly slower market is a more welcoming market for buyers. Now, is this the beginning of a crash, of some imminent doom? Well, the answer there is no, because the sales price is also up over last year, 5.8% to $888,740. Now that's up 5.8% over last year, but down from last month because we are at that part of the year where home prices begin to fall. We'll get into that in a moment. But unfortunately, home prices are still up. And that's an issue because affordability is just about the biggest problem facing California home buyers right now. And that's why I've rolled out Blueprint, my new model for buying a home in California, which reduces the agent's fee from 2.5% down to just 1%. Let me show you why this matters. If you're a California home buyer, you're meeting with agents, and they're all going to tell you that their fee is 2.5%, but they'll say, don't worry about it, we'll ask for the seller to pay that. Now, what does that mean in real life? Well, if you're going after a home that costs $1 million and you offer $1 million plus you ask the seller to pay for your agent's 2.5% fee, what you're really doing is offering $975,000. Because $25,000, your agent's fee, is going to go straight from the seller to your agent at closing. Contrast that with the situation where you're building on the same $1 million home, but instead you're asking for a much smaller 1% fee for your agent. Well, in that case, what you're really offering is $990,000 for the home. Now you tell me, if you're the seller selling this property, which offer are you going to take? you're going to take the higher offer every day of the week. And that's why it's important to work with an agent who offers a lower fee. To learn more, go to www.buywithblueprint.com to learn how to work with a great agent, me, for just 1%. All right, let's look at California region by region. We start in Southern California. This is the largest housing market in California. Existing home sales up 11.9% year over year. That's fantastic. Existing home prices up 5.5% year over year. That's right in line with the statewide average. Unsold inventory is up to 3.3 months. Median days on market is at 27 days. And the sale price to list price ratio is 99.5%. That means that homes are selling for 0.5% lower than they're being listed. Now, when we dig into the crosstabs of the sale price to list price ratio, we kind of get something of a different story. We'll get to that in a moment. All right, looking at the Central Coast, we see that existing home sales are up 13% year over year. Existing home prices are actually down 5.7% year over year. Unsold inventory is at 3.2 months. Median days on market is 22 days. So this is a relatively fast market despite prices going down. And the sale price to list price ratio is 98.3%. Now for the state of California, that's a very low sale price to list price ratio. In the Central Valley, we have existing home sales up 13.7% year over year. Existing home prices up 5.7% year over year. The unsold inventory index at 3.1 months, median days on market at 24 days, and the sale price to list price ratio at 99%. Continuing right along, we're now in the Bay Area, where existing home sales are up a whopping 16.2% over last year. The existing home price is up 3.6% over last year. Unsold inventory is still extremely tight at 2.1 months. Median days on market is still extremely low at 18 days. This is still a very fast, competitive, inventory-constrained market, and the sale price to list price ratio reflects that, coming in at 101%. It's worth noting, by the way, that the Bay Area is the only California region that has a sale price to list price ratio over 100%. And we finish our survey in the far north, where existing home sales are actually down 6.7% from this time last year. Existing home prices are up 3.7%. Unsold inventory is a whopping 5 months. Median days on market is 28 days. And as you would expect in a market that has so much inventory and a relatively slow pace of sales for California, the sale price to list price ratio is down at 97.6%. So regionally, every region except the Bay Area has a sale price to list price ratio below 100%. Now, that would get home buyers excited, except home buyers in the Bay Area. I'm sorry, you're still in a hyper-competitive market. But when we dig down into the sale price to list price ratio metric, we see kind of a different story. Let's take a look. Right now, we're looking at the sale price to list price ratio by percentile. So 0 to 20 means the least expensive 20% of homes sold in California. 80 to 100 means the 20% most expensive homes sold in California. And then, of course, you have 20 to 40%, 40 to 60%, and 60 to 80%. And what we see is that the sale to list price ratio is actually at 100% for all price points except the most expensive 20% of homes in California, which has an average sale to list price ratio of 99%. So while we were looking at California regionally and getting pretty excited about these low sale to list ratios, when we actually look at the homes being sold by percentile, we see that the lower sale to list ratios are really only being achieved at the very high end of the market. This, of course, begs the question, what constitutes this high end of the market? What is the price point of the 80th percentile California home? And the closest we're going to get to an answer in this data set is by looking at this pair of graphs. Sales growth at the top end of the market grew strongly. Now, the first thing we're going to notice here is that homes that cost $1 million or more make up 35% of the California housing market. So that top 20% we're talking about starts at a price point north of 1 million. Is it 1.2 million? Is it 1.8 million? Frankly, we can't say. We don't have the data. I mean, they have the data. I don't have the data. But the point is, if you're shopping for a home underneath a price point of $1.2 or $1.4 million, you're probably not going to get a great discount off of the list price. Now let's take a look at the graph on the left, which breaks down home sales by price segment. And as you can see, almost all of the sales growth in California was at the upper end of the market. Keep in mind, statewide sales growth was up 9.5% over last year. And when we look at price by segment, we see that homes that cost $500,000 to $750,000 grew by 14%, $750,000 to $1 million grew by 19%, $1 million to $2 million sales grew by 16%, and in the $2 million plus range, home sales grew a whopping 31% over last year. Meanwhile, at the lower end of the market, we have a paltry 2% sales growth for homes that cost $400,000 to $500,000, and then we lost sales. In other words, sales shrunk for homes that cost less than $400,000. Now, I'm not surprised that sales shrank for the very, very low end of the market. California is a very expensive market, and that low end is just going to continue to shrink month after month after month. What is exceptional is that the segment that had the highest growth in sales was the $2 million plus segment of the market. I mean, that's very expensive homes, even for California. And this is actually the reversion of a troubling trend that we've seen before. Let me show you in this next graph. Now, this graph actually shows the same data, sales growth by price segment. And each price segment is represented by a different color bar on the graph. So the $2 million plus price point are these tall purple lines. The $1 million to $2 million price point are these green lines next door. $750,000 to $1 million are these light blue lines. And we'll just focus on those for the time being. Now, there was a troubling trend earlier this year that sales were really picking up on the high end, and then very fortunately, that trend began to correct itself. Just broadly speaking, for a healthier market, it's good for there to be a balance of price points from low to high. When sales have stalled in the low and medium end, and they've really only picked up in the high end, that's not a healthy housing market. So it was a relief when high-end sales started to decline. However, with this month, we see a re-acceleration of sales at the high end. So we had this big acceleration beginning of the year. It fell off, and now the trend is up again. That's not great, and this is something we have to keep our eye on month to month as we continue to track the California market. However, this bad news shared, now let's get into some good news. As already discussed, the annualized rate of sales in California is up to 264,000, almost 265,000 units. That's up 9.5% year over year. Now, the pre-pandemic times saw typically 400 to 500,000 sales per year. So we're not quite up to pre-pandemic times in terms of how many homes are being sold, but we're certainly doing a lot better than we were last fall. Where we do see a return to pre-pandemic norms is in the share of homes sold above asking price, which has fallen to a 9-month low of 38.1%. 1 year ago, 42% of homes were selling above asking price, and at peak during the pandemic, we reached almost 73% of homes selling above asking price. Now, as you can see, pre-pandemic, we peaked out around 40% of homes selling above asking price and bottomed out around 25 to 30% of homes selling above asking price. So sitting here at 38%, to me, means we're back to a pre-pandemic trend. Let's take another look at inventory, which has risen to 3.1 months, up from last year's 2.7 months. Now, 3.1 months almost puts us in pre-pandemic territory. I would say that this averages out to something closer to 4 months. But what's really worth noting is that, again, this is not the beginning of a crash. The crash bros who have been wrong since the pandemic started are still wrong. This is what it looks like when a crash is starting. When we get to 6 months of inventory on the market, then maybe I'll start to sweat. What we want so that sellers can be well rewarded for their sales, but also buyers don't feel completely priced out. We want about 4 months of inventory like we had pre-pandemic, and we're on our way there. In fact, total active inventory remains on a rising trend, and this is very cool. I want to show you something in this graph. So this shows total active inventory by year, and each year gets its own colored bar. Now, 2018 and 2019, which we regard as the last normal years, that's this green and blue color. If we do kind of a trend line averaging 2018 and 2019, we see that active inventory slowly rises, it peaks in the summer, and then it falls off pretty abruptly as we reach the end of the year. Now, prices also fall during this end of the year period, so as much as inventory falls off, to an even greater extent, buyers fall off and demand goes away. All right, now let's take a look at 2024, which is this dark red line. Now, at this moment, we only have numbers through October, but let's take a look at what these numbers are telling us. We have a similarly rising trend as we reach into the summer, and then look at this. Inventory has just peaked. It has not begun to fall. That's why this Black Friday period, as I like to call it, is going to be especially good for California home buyers because inventory is even higher than usual. So what happens when you have more inventory than usual and buyers leave the market, because this is the time of year when buyers leave the market? You have price drops. And here we see that active listings have increased in all regions, up 24% in the Bay Area, almost 36% in Southern California, up 30% in the Central Valley, 32% in the Central Coast, and almost 17% in the far north. And we should see this health and high inventory market continue into the winter because pending sales are up almost 21% from where they were last year. So not only did this most recent month see more home sales than the same month the year prior, but it saw even more homes go pending than the same month the year prior. That means we should expect this high number of sales to continue into the winter. In general, we're entering a winter that has elevated sales and elevated inventory, which is going to make it a better winter for home buyers. Now, one last piece of really great news for home buyers. Mortgage payments in California have declined year over year for the third consecutive month. The average mortgage payment in California on a newly purchased home is down 6.1% from this time last year, even though home prices are up 5.8% from this time last year. That's right, the mortgage environment is improving rapidly. And despite how you feel politically, there's good reason to believe that mortgage rates are going to continue to drop as we approach and move into 2025. And guess what, guys? There's another way to lower your monthly mortgage payment, and it has to do with my new model, Blueprint. Let me show you what I'm talking about. All right, guys, let's go back to our $1 million home example. Now, when you get out there and you're looking for agents and you're shopping for an agent to work with, most are going to ask for a 2.5% commission. So if you buy $1 million home, but the seller pays for that 2.5% commission, what you're actually offering the seller is $975,000. Well, guess what? If you want to beat that offer and you're working with an agent who only charges 1%, you can put in an offer for $985,000 plus that 1%, because that's also going to equal $975K in proceeds to the seller. Now, let me ask you a question. Would you rather have a mortgage on $1 million to buy that $1 million home, or would you rather have a mortgage for $985,000 for that $1 million home? Obviously, minus your down payment. If you said you would rather have a mortgage on this lower amount, $985,000, you're correct. In fact, a mortgage on this lower purchase price is going to save you, when you include taxes, about $116 per month, which over the life of the home ownership is really going to add up. Learn more about paying less when you buy your next California home at buywithblueprint.com. And to keep up with the California housing market, stay tuned and subscribe to this channel, where we will cover every new monthly print from the California Association of Realtors.